Okay, so let's just go ahead and start. So we're going to talk about refinances, and on the refinances subject is more like questions and answers. I'm going to pick up a topic and then we'll go from there, and then we go with questions and answers. So let me just go ahead and start with FHA. FHA has three types of refinances. The first one is FHA Streamline. The second one is FHA Rate and Terms. And the third one is an FHA Cash Out. Okay. Now, the first one, the FHA Streamline, this is very important. You don't need an appraisal, and you don't need the value of the property. The value of the property is the value when they purchase the property, and you don't need taxes, but you do need unemployment. So the person has to be working. So, but you don't need income, and you don't need an appraisal. Now, the requirement is that the client has been making the payments for the last 6 months on time. 6 months, right? Not 12. So as long as a client has made 6 payments on time, the last 6 months, then you can do a streamline with no taxes and no appraisal. Now, the only kick on the streamline is that you cannot add to the loan amount, regardless of what you owe on the property. You cannot add the closing costs. Closing costs either had to be paid by the rebate or had to be paid by the buyer. So when you do a streamline, if the closing costs are around $7,000, the $7,000 either you cover them on the rebate or the client has to bring that amount. With streamlines, what we have done in the past, and what can kill you on a streamline is the prepaids. The prepaids meaning taxes, insurance. So what we have done in the past is to request for the current bank to give us a payoff amount, but with a payoff amount that they refund also the prepaids. If they refund the prepaids, then they can refund it to the escrow account, and we can apply them to the new. Does it make sense or not? No? Okay, so let's just, I'm going to. Well, on a streamline, so you have the closing costs, and the closing costs are made by, sorry about that. So closing costs are made by bank fees, escrow, prepaids. Sorry, guys. The impounds, and then escrow and title. Now, if you're talking about a property that is worth about $700,000, the prepaids it can be anywhere between $4,000 to $5,000, depending on the month that you're going to close. So if you cannot add the closing costs, into your new loan amount, everything, the bank fees, the impounds, and the escrow and title fees have to be covered by either the rebate or the client has to bring that amount. Now, what I saw the face of Fernanda saying, I don't get it that you request from the bank. So let's pretend, Fernanda, that your client is right now with Bank of America. Now, the Bank of America has an escrow account where they collect the impounds. In that escrow account, they have Bank of America has $4,000 to $5,000. Now, if you're going to refinance, and this is a new bank, the new bank is going to ask you for an escrow account, and it's going to ask you for $4,000 and $5,000. Bank of America has that amount, but they're requiring it. Now, you have two options. Either you tell your client, hey, I need the $4,000, $5,000 because Bank of America is going to refund that amount within a month, or you can actually have the escrow call Bank of America, ask for a payoff, and also for the credit of the impounds. It's a 50-50 chance, but they can do a credit of the impounds. In that way, the client doesn't have to bring the impounds. You have to coordinate with the escrow. You have to coordinate with the escrow. The escrow can do that service for you. Make sense? Questions? So in the bank fees and the escrow and titles, talk to your bank escrow. Start talking about the streamlines because they can give you a better pricing if it's a streamline. But FHA streamline, you don't need taxes. You don't need taxes. You don't need an appraisal. Now, the same people that are on the current loan and on title have to be the same people that refinance. Same people that are on the loan and on title have to be the same people that refinance. So if Dawson and I purchase a property and now I want to do a streamline and remove Dawson from the loan, I cannot do a streamline. So if I'm going to do a streamline, Dawson and I have to be on the new loan. If for whatever reason, we want to do a streamline and I'm not working anymore, but Dawson is, you only need one employment. You only need one employment. So you can put Oscar as a husband, and Dawson is the one that's working in Simply Mortgage.
So if you and doesn't buy the property, but then you remove a doesn't, that's a change of title. So you cannot do that streamline.
You cannot do the streamline, correct?
You cannot. But what if you add it back? That's not they don't let you do it, or
if you add it back to the title, yes. So as long as Dawson and I were on the original note and Dawson and I are refinancing, then you can do that.
they're not gonna care that you're removing and adding back.
They're not going to care about that. They're not going to care about it. Any other questions?
We just need the BOE, right? We don't need the income, the actual pay stubs.
That is correct. We only do a processor cert that verified employment. It can be also with a CPA letter if the person is self-employed. Now, try to make sure that it jives with the original loan. If the original loan was done 7 months ago, then make sure that is the same job or similar jobs. It's not good. For example, Juan, if you say, well, Jorge is my client and Jorge was working at Whole Foods, and now he's a self-employed, you're going to say that he's a self-employed with 3 years of self-employed. Well, hold on. You just did a loan 7 months ago saying that he worked at Whole Foods, and now you're saying that he's self-employed for 5 years or 2 years. That doesn't make sense. So make sure that it is the same. But we don't verify income. Any other questions?
I think one the commission that rate has to go down at least 5%. Sorry, half of them.
Yes. So you have to. It has to make sense to the client. So what Maria is talking about is that it has to make sense to the client. You cannot do a refinance if the client doesn't save, and if the client doesn't save, specifically on the loan and the MI. Not on taxes, not on insurance. not on taxes, on insurance. So the loan in MI, the client is paying certain amount of dollars. If you reduce that certain amount of dollars by 5%, then you can do a streamline. But that amount, not taxes, not insurance, that amount.
So if sometimes the clients, when they purchase, they have the correct taxes. And then when the supplemental taxes come in, sometimes they increase the payment because of the taxes. So those that doesn't affect us.
Doesn't affect us.
Just check that.
It's the loan amount. The loan amount. So another interesting point that Maria brought, and that you have to be very careful. If a client purchases a property in February, and you're refinancing that person in November, the taxes of this client are not the correct taxes. So if he purchased a property for $800,000, taxes is 1.25 of this amount, but they're not going to be based on $800. Why? Because the taxes are based on the owner in January 1st. So you have to be very careful also, because the underwriter is going to add the taxes plus the supplements. Now, if you tell your client, if they have an issue, supplements, because it could be that you're going to refinance this person, let's just say in October. And if the county has any issue, the supplemental taxes, then you're going to say, well, fudge. I mean, if the previous client had the property at $400,000, and then you see the taxes and they're based at $400,000 plus the loan, plus I'm saving him just out of the taxes, I'm saving him more than $400,000 just on taxes. But that is incorrect. Because it's going to get reassessed, and it's going to get reassessed at $800,000. Make sense? And so make sure that you know that you see that. This week, I sent you guys an email saying, hey, remember, our investors required us to keep the loans for 6 months. So if Jose Pulido did a loan, let's just say we're in January. So let's just say that he made a loan in August. And for whatever reason, this client refinance in January, they have to pass 6 months. So all the commissions, the investor is going to charge Simply Mortgage, and then we're going to charge the commission that Jose Pulido did. Now, that is the agreements that we have with the investors. But on the other hand, and Maria just talked before the meeting, and she says, well, a lot of investors are calling, even the banks are calling the clients, say, I can refinance. We can do a streamline XYZ. On the flip coin, if let's just say nothing against a mortgage company, but let's just say American Funding. If American Funding did a loan, and now the client 4 months after wants to refinance with me, do I deny the loan because 6 months haven't passed, or do I do the loan? Do the loan. Why? Because they're going to charge American Funding. They're not going to charge me. So the guy doesn't have prepayment penalty. So what I told you on the email, clients don't have prepayment penalty. So if I run into a client and the client wants to refinance within 3 months, within 4 months, do I care if American Funding is going to get charged? I don't.
But they cannot do a streamline because they don't have the certificate.
Yeah.
And they have to do an FHA because they need another appraisal and have to wait for a year.
Okay, so we'll talk about that. So you cannot do a streamline, Maria said, because it hasn't passed 6 months. That is correct. And they cannot do an appraisal. The appraisal has to be there. So you do another appraisal and it has to be there. But if we're talking about conventional, don't dwell on that, Maria. If we're talking about conventional, and for whatever reason, the client purchased the property and it was a fixer and the guy fixed it up and now he wants to refinance within 4 months, can you refinance? Do we deny that loan? Don't deny it. You're not going to get charged. The previous mortgage is going to get charged. But if it's your mortgage, we will charge you for the commission.
But the difference is that we do the loan and we have an investor, let's say it's new rates.
Uh-huh.
Okay, that's our client, they will put it on new rates, now becomes new rate, but they're calling our clients. We're not calling their clients. If we get a client for new rates, it's because out of the blue, he came in, I got a referral to go with Maria, but I'm not calling their clients, but they are calling our clients.
That is correct. What Maria is saying is that once we do a loan, if you're a good loan officer, if you're an excellent loan officer, you're going to be calling the clients with high rates. You're going to be calling the clients with high rates regardless if there's mortgage companies that they hire people from other countries just to call regardless of the rate. That's one. Second, if you get with title, you can tell title, hey, who did loans above 7%? Because I can reduce it to 6% right now. Now, if I can reduce it with 6%, give me a list of everybody that did 7%, title company, the title company gives me, and if you're a great loan officer, you call those clients. Now, what Maria is saying, don't take it the wrong way, we're not calling those clients. The mortgage companies are doing. No, Maria, the good loan officers are calling those clients. The good loan officers are calling those clients. The mortgage companies are calling those clients. And the mortgage companies hire a whole department and they're calling those clients like crazy. Now, whether they're going to work or not, they're going to work. Now, some of those clients are going to be your clients. And if the client refinances within 6 months, you're going to get hit with the commission. But on the other side, if you were a great loan officer, if you got interest rates at 7 from a title company and you call those clients and you refinance and it's within 6 months and you refinance, let's just say conventional loan, do you care that they did the loan with another mortgage company? No, you don't. The other mortgage company will get charged, but you don't care about that. You don't care about that. So take the client. Does it make sense? Consumers, does it make sense?
Yes, it does a lot.
Mm-hmm. It does. Mm-hmm. Questions? Comments? Mm-hmm. Now, if you run into a situation, is Gonzalo in the meeting? Because Gonzalo is going to get mad at me because he's going to say, well, Oscar, how do you expect me to reduce a 7% and then go down to, let's just say 6%, but with the rebate, cover the closing costs of the client. If I do that, then I don't have any rebate for me. At the market that we are right now, it's very complicated. It's very complicated that with the rebate, you cover the closing costs. So Gonzalo might say that. Now, what I can tell Gonzalo is, well, you can do a refinance, a regular refinance. And if you do a regular refinance, then you can add the closing costs into the loan amount. But a regular refinance has to be with taxes and with an appraisal. With taxes and with an appraisal. Now, Maria brought out an interesting point, and Maria said, well, Oscar, I don't think that the appraisal value is going to be too high to cover that. It could be. But when you do a rate in term for whatever reason that I don't understand, for whatever reason that is weird, it's like FHA just smoke a joint. The maximum that you do with an FHA is 96.5. But when you do a rate in term, for whatever reason, FHA goes all the way to 98%. 98 point what? Do you know? No. So the maximum that you can do on an FHA on a rate in term, regular refinance is 98%. I think a little bit higher than 98%. So you can cover the closing costs, even if it's the same value as before. Even if it's the same value as before. Make sense? Questions? Comments?
But they don't allow you to do a new appraisal within a year, correct?
If it's rate in terms, yes. If it's cash out, no. Pulido, am I right?
I concluded it was 97.75.
97.75. 97.5 is the maximum that you can do on a regular refinance. Mm-hmm.
As I believe, there's always an appraisal.
There's always an appraisal, but they don't take the new value unless it's 1 year that you purchase the property. On a rate in term, it can be anytime. As long, it can be any time, as long as the original appraisal is good for 4 months. So the original appraisal is good for 4 months. So if the client purchases a property and then he wants to refinance within those 4 months, it has to be by the original appraisal. If you're doing a rate and term, after 4 months, you can do a new appraisal. Okay? Now the MI on an FHA. So when you purchase an FHA, for 800,000. You put 3.5% down payment. 3.5, it should be $28,000, I believe so. So you do a loan for 772, and then you charge the upfront mortgage insurance premium. And it's 1.75 of this amount. 1.75 of this amount is close to $12,000. $12,000 that you add to the loan amount, and then you end up with a loan amount of $784, more or less. When you do a refinance, you have to charge this amount again. So not only the client is at $784, but you have to charge this amount again over $784. When you refinance, you have to charge that amount. Now, FHA gives you a credit depending on the timeline that you're refinancing. If you're doing it within 3 years, they give you a credit back. The credit cannot be more than 80% of this amount. But the more time that it goes by, the less credit that they give you. That credit, Pulido is going to explain it within the next couple of minutes. He's going to explain the credit because he has an Excel spreadsheet that it explains to the credit. Make sense? So you do have to charge it, and then you get the credit. Questions, comments? We had a situation, nobody caught it, and the loan officer got very mad. Fernanda, can we talk about it? So we had a situation, nobody caught it. It was a loan by Fernanda. Fernanda gave me permission to talk about it. Fernanda discussed the loan with me, discussed the loan with Pulido, discussed the loan with Phil and everything, and we never caught it. That if the client has a loan and then he has a HELOC or solar panels that you need to pay off. The ADU was the HELOC. It was the loan for the HELOC. So, or any other loan related to the property. Let's just say that there's a water filter that sometimes people install. There's a friend of mine that installed windows and they did another loan and they put it on title. So if you're doing any loan plus any other loan, if these loans were not done at the time of the purchase, then it's a cash out. You can.
I'm sorry, one minor exception to that is the PACE.
The PACE?
The PACE, that they'll consider a rate of term. We have PACE or Hero loan.
Okay, so if it's PACE or Hero loan, Pulido says that is a rate in term. It could be more. Say that again.
The PACE on Hero can be at any time.
You can pay it off, and it could be at any time, and it's considered rate in term. Other than that, any other loan is considered a cash out if it was not done at the time of purchase. So, for example, right now we have the down payment assistance program. In the down payment assistance program, I believe Jorge explained it to some of the agents. Juan Ramirez, what is the kick on the down payment assistance program? That you do 2 loans, right?
Yes.
A first and a second.
We have 96.5 and 3.5.
Okay, you can do a 3.5, you can do a 4.5, you can do a 5% help. Now, those two loans, you do them at the time of the purchase. If you refinance both loans, it's rate and term. It's rate and term. But if you did one and then you did a HELOC 2 months after, they were not doing it at the time of the purchase, so it's a cash out. Any other loan is a cash out. What we thought is that we were doing a loan refinance and we were considering rate and term. And when it became a cash out because Fernanda was paying another loan for an ADU that the client built, we opened a can of worms. And it became a cash out and other rules apply. It was a shame because Fernanda was with this client working for months. We had it in escrow for more than 20 days and nobody caught it until the end. So you have to make sure that if you're refinancing two loans, it's a cash. If it's a city loan and you're going to pay it off the city loan, then it's a rate and term because you did it at the time of purchase. Questions, comments? No questions? No comments? Okay, so Pulido, can you explain the help for the? Can you put Excel?
Oh, right. Have your.
Thank you. I don't know that I'll need Excel, but testing. I don't think I'll need it. Oh, wow. Okay. Let's see who's this. Did you just bring this one or where was it from?
You did it for
Oh.
so you're familiar.
I guess so. Okay. First of all, good morning, y'all. Just a little addendum to what he was saying to the before I get into this. So the streamer, I love it. There's for some clients, it's a perfect tool. It's similar to what the loans that we did almost 20 years ago, the Ninas, right? Remember Nina? No income, no assets. Well, this one is Nina with another no income, no assets, no appraisal. Okay. So with that said, there's also but we won't get too much into that. There is a credit qualifying streamline. Okay. For the exceptions of title changes or like that but for that one, you do have to qualify. Still no appraisal, but if you make any title changes, someone coming out of title, then the person has to qualify. Whoever's staying on the loan has to qualify, just like a regular refinance. Okay, just the only difference, no appraisal. Okay, that was all. So FHA, as you know, they're just like loan officers, they make more on each loan than us. They make 1 3/4 points with the upfront fee, right? Whereas we make, well, except for a certain loan officer, but anyway. But every loan, 1.75, boom, your upfront fee. Plus they charge, they charge the monthly. Now, if, like Oscar said, if within 3 years you refinance into another FHA loan, you have an existing FHA loan, you refinance into another FHA loan, whether it be regular FHA, whether it be streamline, whether it be cash out, there is a portion of the original upfront fee that is going to be refunded back to you. Okay. The way they figured it, it's not a complicated process. Right off the bat, as soon as you fund the loan, they're going to take 20% of that upfront MIP. So let's say in the next month you're going to pay it off. For whatever reason, you win the lottery, you no longer need a loan. Okay, you buy a house today, 1 month later, you want to pay off that FHA. I'm sorry, forget everything I said. No, you don't pay off. You only get the refund if you're going to refinance it to another one. But whatever, if it was 1 month after, it's going to be 20% plus 2%. Every month it declines 2%. So it's designed that after 3 years, you're going to have zero back. And that's exactly what this is. I could send this guys to you again, whoever doesn't have it. But yes, sir.
So the most that you can actually get on refund, the most would be 80%. They're gonna make 10.
78.
Huh?
78, because 20% when you fund, 1 month later, it's already 2% less, so 78%. Yeah, that's the maximum if you refund right away. I mean, refinance right away. So, and because I'm not an expert at Excel, I put in that formula somewhat like I knew. It's a minimum 6 months because the FHA rule says actually 6 payments, not necessarily 6 months, because you could close a loan January 1st, but not have a payment until March 1st. So, yeah, so it's going to be at least 7 months, okay, before you could actually do this. So at least 6 payments. FHA needs to have 6 payments before you're eligible for the streamline. So the way this is calculated on your Excel that I can send you guys, but it does exactly that. I put in the amount of months that have elapsed since you purchased the property. So just by putting the number, it's going to calculate already your refund based on this. Okay. But how does that help? You're still going to end up with closing costs. As Oscar was explaining, you cannot increase the loan amount on a FHA. The only thing, but it will increase. It's going to increase because of the difference in your upfront mortgage insurance. Because on a new property, you're going to pay the full 1.75, and then they're going to take deduct the credit. And then that's going to be your new loan amount. Okay, so was it clear enough? That I think that's all I had to cover.
Jose,
Yes.
I got an email from you, and it was in regards to someone, because you did the calculation,
Right.
and the savings ended up to be like $280. And when
Okay.
I did my numbers, it wasn't like 280 because of the rate. But then you said, well, wait a minute, is that because only of the rate? It's also because of the mortgage insurance. Can you talk a little bit about that?
Okay, so Jorge had a file. I was looking at our pipeline from the first 3 months of 2023. Why the first 3 months? If you guys can remember, we had a change last year in FHA, effective March 1st or April 1st of last year, I believe. The monthly MI rates changed, right? So because of that, the first 3 months that all FHA loans funded in those 3 months were at the higher rate, especially with the high balance. As you guys remember, FHA, anything over 625 was already a high balance, regardless of the conforming limit. Now they are just mirroring the conforming rates. Okay, so whatever the conforming rate is, your rate is 0.55 for minimum down payment and 0.5 for 5% or higher down payment. But where prior it was 1 point and 1.05. So that was the difference. So right now you can take if you did a loan within those 3 months at the higher rate, even if you calculate today at the same rate that you got them last year, you're going to see a savings because of the mortgage insurance.
Yeah, so that was a very good point, because I wasn't thinking about that until you actually sent me the email, so thank you for that.
Okay.
And the other thing is that it makes total sense that, if you were, if you were a conforming rate, maybe it's not gonna be that big of a difference, but because of the new loan amounts right
Right.
now, so if you did a deal, for example, for 770,000, let's say at a purchase price last year, that was a high balance deal. And that was with a higher MI on a monthly basis. So today, because of the conforming rate, and the mortgage insurance is lower, not because you're not gonna knock like 2 points off the interest rate,
Right.
it's still gonna make a big difference on the payment. So I just wanted to bring it up and thank you for that.
Yes, yeah, so I'm not sure if the Zoomers were able to hear what Oscar was saying, but Oscar, I'm sorry, you guys look alike. Okay. So and another factor to keep in mind is since our conforming loans keep going up every year, so if not only will you be able to save on the upfront mortgage insurance, but also, I'm sorry, the monthly mortgage insurance, but also you're going to get better pricing if you close a loan last year that was a high balance loan, because you're also going to get that high balance loan will now, depending on the amount, is most likely a conforming loan where you're going to get a better rate. So you close at high balance last year at 7%. Well, I think you're going to get on a conforming rate, you're going to get better than 7%.
Yeah, because
Today.
balances, I believe last year, they were like at 7.5,
Right.
if I remember correctly. And now you can get them at maybe 625. Let's say that it's a streamline, you have to go up to 675. So then you got a lower mortgage insurance, and then you get the credit for the upfront MI. That could definitely make sense.
And if not within your database, because I saw the loans, I try to check all the FHA loans that we closed within for all of us in the first 3 months, and unfortunately we didn't have that much of a group. The ones that we did, I did emails just like you and say, okay, check into it. But as Oscar pointed out, you could reach out to the title company and specifically give me a list of the first 3 months last year, any loan between this and this, and those are potential refinances as well. Okay, so any questions on any of this from any Zoomers or you guys? Otherwise, I turn back to you. Okay. So anyway, I have this Excel in case you guys need it, where you don't have to do the thinking. Basically, just put in right here the number, how many months ago they closed, and it'll calculate your refund.
Calculate the month you close or the first payment made.
Yeah, no, very good. Not the monthly you close. It starts with the first payment.
Okay, thank you, Pulido. How do we remove this? So guys, obviously, so some of you have become a very Instagram active, and you get the leads from the Instagram. But there's in the past, I mean, if you go to title and you get a list, it's very simple for a title company, very simple to say, hey, tell me everybody that closed within January 1st to March of 2023, and it has a rate above this rate, and they will give you a list. Now, I remember some of you on Zoom, they did a lot of letters. Obviously, the letter has to be catchy. The letter it has to have a punch, and just say, hey, I can refinance and I can lower your payment. I can refinance and I can lower the payment. I mean, obviously, some of those clients are not going to see you on Instagram, but if you do that or if you call them, I mean, there you go. But you have to be on top of it. You have to be on top of it. Now, the other side is that everybody's going to complain because another lender called my client. Well, yeah, chingada madre, pues they're calling their clients. You should do the same thing and not complain. You should do the same thing and not complain. So that's that. A loan officer that is on Zoom right now sent me a deal to review, and the client was about he owed in his property about $300,000, and he wanted $50,000 cash out. Now, what I did first is if the client qualified first. So I did the numbers and see if it qualified first, and the client didn't qualify by itself. But so I called the loan officer. I said, hey, I think he's above 50%. We're not going to be able to do this loan unless we get a cosigner. Give me one second. So, but the first thing that came to my mind, is that the 300,000 was at 3%. The 300,000 was at 3%. So if I combine both at 350 and do a cash out, what is the rate that we're gonna get? Competitive rate. Anywhere between 6.5 to 7% on a cash out. Not even considering his FICO. So now I'm turning 350 into this amount. So before I respond to the loan officer and I say, hey, dude, you need to do a HELOC here. You don't need to do a cash out. Probably you need to go to a HELOC. Before I did that, I reviewed that the client qualifies. He didn't qualify, so we call it a day. Give me a cosigner. But if you're in this situation, if you're going to send 350 to this rate, it's going to be very hard for the client. It's going to be a very high payment. If you do a HELOC, then just do a HELOC and give the service to the client and maintain a new client. You're not going to make too much on a $50,000 loan on a HELOC, but try to maintain the relationship with the client. HELOCs you can do with symmetry, you can do with the lender, you can do with all kinds of relationships that we have. But try to see that. Try to see if what makes more sense. What makes more sense. If I told you on a previous meeting, that we don't like, no bank likes it, but Simply Mortgage hates it. But if you have a house, and then you have a house in, let's just say, California City, and then you refinance that house and do a cash out, and you refinance, and you do a cash out, and with a cash out, you want to buy a house in Pando because it's closer to your job. Banks don't like that you do an owner-occupied refinance and then you buy owner-occupied within certain months. They don't like it. It has to make a lot of sense. But if you do it at the same time, it's not going to fly with any bank. If you do it at the same time and you do owner-occupied and then you're going to buy owner-occupied, it's not going to fly with any bank. Now, what I can tell you, Simply Mortgage wishes that at least 8 months pass by. At least 8 months pass by. I can tell you also that other banks can do it within 3 months, 4 months. If you do it within the same month, it's not going to fly with anyone. You lied to me. You did owner-occupied and you knew that you were going to move to another property. Now, if you run into a situation where 4 months have gone by and you want to do it with Simply, then at least 4 months, 5 months. And then I go to fight with Oscar. Now, but, and you might say, well, Oscar, isn't it the same? Well, we don't see it the same. But if you have a house in California City, and you do a HELOC, then a HELOC, when you run DU for this property, the DU picks up this financing, and this financing was done way back. So you did a HELOC, and now you're using this money to buy owner-occupied. We don't care. That's okay, and you can do it within 1 month. And Jorge just closed one. Did a HELOC or you're in docs right now, Jorge? So we did a HELOC, got money, owner-occupied, boom. We don't care. Why? Because when you run DU is going to pick the financing that you did on this property. DU doesn't pick the HELOC. So DU is not going to say, hey, this guy just did a HELOC with owner-occupied, now he's lying. Doesn't do that. So the underwriters are very lenient on that. So if you face the situation, try to go with the HELOC and then the other property. Make sense?
Just don't tell the HELOC. But the person.
That is 100% right. That is 100% right what Pulido said. Just don't tell the HELOC that you're using the money to buy another property. Just don't do the transaction and disclose this property with the HELOC. Don't do that. So do the HELOC, close the HELOC, get into the other transaction. Now you can use the rental income on this property. If you're doing a conventional, you can do the rental income on this property, and if it covers both mortgages, then you get rid of the both mortgages and you buy it for you. Make sense? So that was pretty much questions and answers. Is there any other questions, subjects regarding refinances? No? So then we'll stop here. Thank you.